utilize our cutting-edge client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
I can't hear you, Justin. Can you hear me?
How about now? Wow, that was an exciting introduction. Thanks everybody for joining us. I was going to talk about St. George, Utah, but maybe I had my 2-minute chance to do that. I know we usually keep this to an hour. I'm excited to be joined by Jason Brooks once again. We talked about Prop 15 2 weeks ago. We were going to talk about just Prop 21. We're going to talk about Prop 21. We're going to talk about AB 3088 and the nationwide eviction moratorium. On the surface, is it all great news for investment property owners? No. And we'll cover all the things that you need to be thinking about and need to be aware of. But we're also going to talk about some opportunities today, because whenever things like this happen, change occurs, and there's things that people can do to take advantage of it. It might not be the status quo. It might be a little bit different than what you expected. But if you want to grow your portfolio, if you want to make more money, if you want to make things easier, there are things that you can do. And we'll talk about those down the road. I'm going to get started with Jason. Thanks again for joining us, bud. We'll talk about the three issues. Why don't you start on the nationwide eviction moratorium, and then we'll go into AB 3088, and then we'll talk about Prop 21.
Got it. So we'll start with earlier this week, the federal government, under laws essentially governing the CDC, passed a nationwide eviction moratorium. And there are more stringent requirements to meet this in certain aspects than what you see in California. And it's not as, prohibitive against different property owners as the law in California is. But what it is the CDC regulations allow for health benefits to the nation to allow you to pass laws. In this case, they say if there's homelessness, if there's a higher chance that the disease spreads, therefore, if you make under $99,000 a year federally, you can then ask for this eviction restrictions on your property, provided that you provide paperwork to your landlord stating that you have been substantially affected by COVID and your income is under $99,000. Over $99,000 is a little bit of a different story.
All right. And did you happen to see, I just saw this afternoon that the governor came out and said that the CDC eviction ban doesn't apply in California because California had their eviction ban prior to the CDC and national ban.
I would say that the national ban probably doesn't apply in California, but for a different reason. I think the governor is wrong on that sense. This could also be, it's a difference between a state law issue and a federal law issue. This is one of those issues where I believe that the state probably has the right to go more restrictive if they want to a certain point. But I do not think that a state could go less restrictive than the federal law. So the federal law applies in states where, let's say that there is no law right now, or the law that they had in place was less restrictive than the federal law would control. But I do believe that there is an opportunity for the states to go more restrictive in this situation. So the governor though thinks that we are a nation state. I think he referenced at one point during this, and so I think he's probably thinks he has more power than the federal government.
Relying on that proclamation. Just a reminder to everybody who's joining us, if you've got a question, feel free to write it in the chat. Jason and I have talked about some of the things that we want to cover because we think this agenda item alone has so much, so many places we can cover and go. We will get to your questions throughout the day. And then you'll also notice in the polls section, I think we've got 6 questions set up for everybody today. We'd love to get your participation. Jason, talk for a minute about AB 3088, that for everybody who is finally enjoying getting out, getting a little exercise, maybe getting out for dinner. Nobody noticed what the legislature was doing over the weekend, and AB 3088, which is as we just discussed, the state's eviction moratorium.
And I find it interesting what they tend to name these bills. They name them something like they're doing something really protective for certain people, but they don't think about how it's going to affect others. So essentially, there's an eviction moratorium now in California until the end of the year. And what they essentially, the law says is that any debt that's been incurred up to September 1st is now converted into commercial debt, and it cannot be the basis of a foreclosure or of an eviction. And then if you pay 25% of your rent from now till the end of the year, anything missed is also considered commercial debt and is converted. So therefore, in theory, you would actually become a creditor. So you would have to, kind of, force people into bankruptcy by trying to enforce your rights as a creditor. The other thing that I found really fascinating about all of this is you get 2 bites at the apple at a tenant on the secured debt or on the credit that you're essentially lending to them now. And you can only go after the amount that they owe you twice, and you have to do it in small claims court. So while small claims court in California is normally capped at $10,000, secretly in this, they raised the cap so that you can go collect your debt in small claims court. It means that you really can't hire a lawyer. You have to go self-represented. A lawyer could prepare you, but it's going to be self-represented people in front of not always a judge either. What most people don't realize is there are not always judges presiding over small claims courts. There's administrators who are lawyers and either former judges or appointed officials. So you're going to go through small claims court process to recover this money instead.
I'm going to slow you down, or at least go back and have you repeat some stuff. Talk real quickly the difference between my tenant didn't pay rent in 1999 and I want to get them out, and the process to get them out and recover, versus 2020 or 21. My tenant can't afford to pay me. They owe me a bunch of money and they need to be out.
So if you wanted to evict someone, you would give them notice that, to quit, to perform or quit, and to evict and get out. Then you would go and file with the court an eviction. That has been stalled in this situation because any money that is owed to you right now. So let's say since March, you have a tenant that hasn't paid rent. So April, May, June, July, August, let's just say, and September now. So 6 months, no rent, or 5 months in this situation, no rent, $2,000 a month. They now owe you $10,000. That $10,000 is now converted to consumer debt. You're no different than them owing their cell phone service provider or their utility company the money. So you can't, and it's no longer allowed to be the basis for the eviction, the money owed either. So you now would have to essentially force the person into bankruptcy or go through debt collection processes like you were a normal company to collect that money. Now, the eviction process is going to eventually go back to being the same, but there are new timelines on when you can file, new bases and reasonings for the eviction. People have a longer chance to respond. The interesting part too is Justin, is oftentimes, tenants could play games and maybe say take a year by delaying court hearings and other things. Now, a tenant can file for bankruptcy because they have consumer debt, and they could delay potentially their eviction for 2 or 3 years. It could be pretty difficult for a while.
Any other parts? Let me go back to my notes to see. You talked about you get only 2 chances, or cover that for a second.
So the amount of money that you're owed and going to small claims court to collect that, they didn't want you to be able to go every single month and continue to file against the tenant. So you get 2 chances. I presume that they did this, one for the first amount of secured debt, that's essentially March until September, and then the second amount of secured debt, should they not be paying, or should they only be paying the 25%, that amount of money will then be the second. So you could actually, as of now, it's been converted to secured or to credit debt. You can actually go and file to collect that in small claims court. Now, the small claims courts are probably gonna be pretty backed up, but you can go start trying to collect that money from your tenant. So you can still evict people, by the way, just not on the basis of not paying rent. Like if it's a nuisance tenant or other issues, there are still ways of eviction right now.
Talk about some of the effects for individual owners on the legal side of this, whether it's noticing or any additional requirements and things that come of this, aside from the, let's call it, economic impact.
Yep. So there are different noticing requirements from a time perspective. There are also, I believe, and I haven't dug fully into that part of it, but I think there's anywhere from $1,000 to $2,500 worth of damages paid to the tenant for incorrectly or falsely serving notices on tenants doing things where essentially it's predatory to try to force them out. And if they've provided you information, or if they are not paying for COVID, there are going to be penalties. And if there aren't now, I know that they were originally discussed in the bill. I'm presuming that there will be an amendment to this bill in the next week or two that we will see, because this was done at the 11th hour. I mean, I think, Justin, you sent me the original text on Friday afternoon, and it was passed on Sunday night. Like, they released the draft of the text on Friday evening, and it passed on Sunday evening. So that didn't leave a lot of opportunity for edits or for making sure that things were done correctly. I think they crammed it through because they had a September 1st deadline, and then they're going to go back and fix things.
All right, great. Now I think the other part that everybody's got to consider is, what are the economic impacts? We know from a management or an ease standpoint, some of the things that you just mentioned, but it looks like we'll see, short-term cash flow disruption, long-term impact on debt. Likely the debt, in speaking with some lenders, the likelihood of debt being affected is all the way through the payment period or the repayment period, or at least when, owners can kind of get past this. What's interesting is that I think with all of this stuff, for the most part, everything is seeing the impact of shutting down the world's, greatest economy. But I think for owners, the biggest impact is not just going to be in the cash flow, but to the value of the property and really the performance of their equity going forward. Short term, the cash flow implications in our early conversations and our belief, we think that there's probably 15% of the tenants that across the board that could pay and that won't pay. We think a good portion of your tenants want to stay in where they're living. They don't want to get behind. They don't want to deal with the issues that'll go along with trying to dodge the payments. And we also believe that there's 15% of the tenant population that really needs the reduced payment in order to stay in their place. So in the short term, 30% of the average income stream in a building will be paying about 25%. So you got to figure that owners are going to be, let's call it plus or minus 10% on about a 78% collection of their rent. Right now, because of debt coverage ratios that we've seen from lenders, even probably the most leveraged conventional owner or recent buyers are not going to be negative in their monthly cash flow. Buildings won't be profitable, but we don't think that there's going to lead to a significant increase in default. Owners who live off the cash flow, retirees where the cash flow from their building or buildings is, how they pay their monthly bills, are going to be significantly impacted over the next 24 months. In the short term, there's going to be a good percentage of the tenant base that's only going to be paying 25%. And as those tenants enter the eviction process for paying no rent or the repayment process, owners are going to be affected. Once we get past these dates, owners are going to have additional eviction costs and lost rent due to the backed up court system. And then once they can get through getting some of these tenants out, the cost to turn the unit, put in new flooring, new whatever needs to be done is going to be an additional, more frequent short-term cost for owners. So although the 24% period is only 5 months long, we believe that cash flows are going to be impacted for much longer. But the bigger impact, we think, is in the values of the property and the impact on the capital markets and debt. While most owners are going to survive, not make cash flow, but kind of stagger through, the real financial pain will come from the loss of liquidity in the debt market. We've talked to a number of lenders. We had Joel on last week who spoke about the capital markets before this. Probably should get him on and some of our other lenders on again to participate in what they think we're going to see. But from our standpoint, because of this legislation, we believe that we're going to see increased loss to lease and vacancy underwriting. This is going to impact the loan dollars for buildings, and we believe that loan to values will sharply decrease, and therefore the prices that buyers are willing to pay will decrease significantly. I wouldn't be surprised if we see increased expense underwriting for both legal cost and turnover from lenders. Again, significantly decreasing LTVs and what borrowers are accustomed to. We know that lenders want to lend right now and that they're aggressive in the rates that they are offering. But this change to the potential of the income stream is going to make many lenders more cautious on what they're willing to do. We also think that increased reserve requirements, in addition to the underwriting impacts, are going to allow fewer borrowers to be able to get debt. And so what we've been seeing is that typically mortgage reserves have been in the 6 to 12 month range for what lenders are requiring borrowers to carry. Last night, in speaking with a loan originator, he estimated and assumed that would be push out from anywhere between 18 and 20 months, the mortgage reserves that lenders would require. All that's going to do is it's going to mean fewer borrowers are going to be able to get whatever max loan to values are available from a lending perspective. So there's going to be fewer buyers in the marketplace. Jason, do you have any additional comments or perspective that you've heard from clients over the last few days about their outlook and the impact of this on values and the equity that owners have in property?
Yeah, absolutely. So one of the big things to keep in mind, by the way, that might be the saving grace for a lot of our clients collectively, is the federal bill says that there will be financial relief for small property owners. It's not defined. They haven't said what it is. I'm assuming that they were trying to put it in that $1.2 trillion plan the president has announced, but has made a lot of famous news recently. People are in San Francisco getting hair done, not in DC. So how quickly that goes through is going to be a question. But there should be some financial relief coming to, our average client. It's not going to go save Blackstone or BlackRock or anybody that owns, CIM that owns 100,000 units or, anybody like that. But for our client, it will be there, hopefully, if they keep the rest of the federal bill, if they honor their word in the federal bill. So that's one thing to keep in mind. The other thing to keep in mind is, just really quickly from an operational perspective, because you touched on it, and I think that goes into underwriting, is consider different strategies to entice the people that have the ability to pay but aren't paying to get them to pay. So like if we've seen clients where people were behind, we knew that they could pay. They said, look, if you bring it fully current right now, we'll give you a 10% discount on the amount owed. And if you stay current between now and the end of the year, we'll give you 10% off. Because in theory, collecting 90% of the rent is better than 0 or 25% when you know that they can pay. So sometimes it's worth it to go to those tenants and try to determine if they really can't pay or if they're just trying to take advantage of the system, and then giving them some sort of financial benefit where in their mind, they got something out of it and they're not going to have this big detriment at the end. So that's just a management thing to keep in mind that's available to you, is getting ways to entice people to pay. And then Justin, just from a lending perspective, we've seen it's harder on cash out refis now already to a certain extent. And I think it's going to be even more difficult now. From an acquisition perspective, I think to your point, there's going to be more restrictions, but the cash out refis, if you're just trying to take advantage of a really great rate right now, it might be more cost prohibitive. Or if you thought you were going to pull out $500,000, you might now only pull out, 250,000 because they're going to require you to either take a lower loan to value or keep more money into a reserve account, stuff like that. So the Fannie and Freddie small balance loans we saw the other day, obviously that there's the yield maintenance, but I saw a deal the other day that was in the 3.1s, 3.2s on a $1.7 million loan. So it's great money as long as every loan has its pros. You get it. Right. Well, every loan has its pros and its cons, right? Like, prepays versus no prepays, guarantees versus no guarantees, higher rates, less recourse, all different things. It's about balancing what works for you. But if you have a stable property, you might consider, that 10-year, 7-year debt from the government, because since the beginning of this starting, the only people that the federal government have been able to protect from a borrower's perspective are people that have Fannie Freddie debt. Since day one, they've announced protections for those people. So if you're in that situation and this happens again, at least the government has your back. It's just something to keep in mind too.
Awesome, bud. Thank you. Interested, taking a look at the polls so far. So our first open poll, or our first poll of the day was, will prices be higher? And it was split, yes and no. Interestingly enough, though, when we go to our second question, will rent be higher in 12 months? 62% of the respondents say no. Okay. So that's changing a little bit. This is like live. This is like election night. But with more of you saying no than yes, it's interesting to think that values will go up while rents have gone down. Yes, interest rates are fantastic, but I would caution everybody to think about what this legislation and the next one we're going to talk about, Prop 21, will do to the capital available, or the ability to get capital and significantly get leverage on these assets, and how possibly LTVs going from the 60 to 70% range to the 40 or 50% range because of more conservative underwriting affects buyer appetite for buildings. So Jason, with that, why don't we move on to Proposition 21 and talk.
Justin, too, what you were just saying, it might affect cap rates then too, right? Like the appraisals and the underwriting too might get affected by cap rates in those kind of situations. So that's just something also to keep in mind. I know you and I have talked a lot about our cap rates going to change. There's a chance, right? And that affects appraisals, which affects underwriting and ability to borrow, which will affect both refis and purchases.
Well, if there is more risk in the marketplace, cap rates will change and they will move up and decrease values because there's more risk in the market. I think if you talk to many, lenders today, they would say that there's probably more risk in the marketplace this week than there was 12 months ago, or even 3 months ago. When we look at Prop 21 and how it's polling today, but even beyond that, what might happen even if it gets defeated and then passed in some form in the legislature, it seems to be getting to be a more risky environment. Yes, rates are great. We'll talk about the positives, the strategies, the things that you can do to be successful in a minute. But let's talk about Prop 21. Let's get everybody up to speed on exactly what it means, what the impacts will be, and then we'll go into how it affects owners, and then what we think the options are, and more importantly than the options, the opportunities. I'm going to preface, I should have done this earlier, but preface all my comments and maybe make my disclosure multiple times today. But I've been in this business 20 years, and for all those 20 years, I've had a hard time working in California and figuring out why people wanted to move lots of equity out of state, unless it was for a net lease transaction for somebody who was looking for capital preservation. I've believed that because of rent growth, because of the opportunity in California, because of the lack of availability of land, that you got more bang for your dollar when you added up the cash flow and the wealth accumulation. You always got a better bang for California than you got in, let's call it Nashville or Tampa or something like that. In 20 years of doing this, I think things have changed though. And in California, professional investors are going to borrow at crazy low rates and make good returns. But for everyone else, if making money on real estate is what they're doing, you almost got to look at real estate, making money in real estate like a track today. And each state has its own lane. And there's a couple lanes that are downhill and really good material for running fast. And the California lane has sand, it has hurdles, an alligator pit, and maybe you got to wear a blindfold. Well, everybody's still going to get to the finish. Investing in real estate is, in my opinion, a great way to build wealth. You might not get there the fastest or the easiest on the path with the sand, the alligator pit, the blindfold, etc. So let's go into Prop 21, and then we'll talk about options. I'll give my disclosure again about how much I've already loved California, but see opportunities today for people to do better. So talk a little bit about Prop 21.
So Prop 21 is essentially the replacement, as the proponents would refer to it, or the repeal, as the opponents would refer to it, of Costa-Hawkins, which essentially was passed in 1995. And
it's not what the proponents would call it.
The
proponents wouldn't call it just the repeal of Costa-Hawkins.
They would call it the replacement. The opponent would call it the repeal. So the replacement, like it's an improvement. So essentially, prior to Costa-Hawkins, local governments could enact rent control provided that the landlords would receive just and reasonable rents on their property. Costa-Hawkins continued to allow governments to use rent control, except on housing that was occupied after February 1st, 1995, and housing with units that had distinct titles as condos and single-family houses. What the repeal of Costa-Hawkins would allow is that local governments can now adopt rent control on housing units for housing units that were built in the last 15 years. So that means anything from 1995 till, let's call it 2000, end of 2005, would now be eligible for rent control. And units owned by people would be exempt so long as you didn't own more than 2 housing units with separate titles, such as single-family homes, condos, and then it says some duplexes and subdivided interests, such as co-ops. I think they would probably keep it to the way that the definition is now. Anything 4 units or less is still, in theory, considered a single-family home. So it would allow any local government to enact rent control more restrictive than AB 1482 and the statewide rent control. I think the biggest portion of it, though, and Justin and I probably lose more sleep about this than the other parts of it, is what's called vacancy decontrol. Essentially, under Costa-Hawkins, when you do have rent-controlled units, if a tenant leaves, you are allowed to bring the unit up to market rate. In this situation, what will happen is the ballot measure would require that local governments adopt a rent control that allows landlords to only increase rental rates by 15% during the first 3 years of the vacancy. That 15% increase means is if you've had a tenant in for 30 years and they are 400% below market, you still have to charge a substantially reduced rate over time. I think that's the biggest detriment of the entire law. I mean, we've learned to operate under 1482 and it hasn't been the worst thing in the world. The vacancy decontrol, I think, is the part that would really hurt affordable housing here in the state of California.
Talk about why you think it would hurt affordable housing, not necessarily our issue, but certainly providing housing has been the argument for all these rent control bills is a lack of available cheap housing. How do you think it affects development of more additional housing that would solve the housing crisis?
So if you're going to have, affordable housing being built, it would be exempt. But what I think is when you have all these units that are, rent controlled right now, the reason that they're able to be maintained and stay nice and be good properties is because the landlords are able to bring them back to market when a tenant moves out. But if it really kills the value of a building and it disincentivizes a landlord from, either repairing the unit, making it nice, it would also probably incentivize people to look at condo conversion or selling. I mean, I have clients that take small apartment buildings and turn them into tenants in common buildings where it's like a condo, but without each unit deeded. So you own 1/8 of the building and that's your unit. People would look for opportunities to take away rental units. Ultimately, at a rent control building, if you move in and you can stay in there for 10 or 12 years, you're going to be ahead of the game on your rent. It's going to cause people to remove those units from the market. So you'll see more Ellis acting of buildings. You'll see people trying to take rental units off the market, which will then restrict the amount of affordable units under rent control in the future.
All right. One of the provisions in 21 is that the nice part is that they're going to allow owners to make a fair return on their investment. What's that?
Well, in theory,
who decides it?
I can close my eyes, look at a dartboard and throw it and hope I hit the right target. In theory, a fair return was bringing it up to market, right? And then a set increase. Now, a fair return is what the government tells you a fair return is. And they don't consider if you have investors, they don't consider your current debt on the property. They don't consider, if you're going buying a deal knowing that there's a 87-year-old tenant in one of the units who's likely going to be moving out in the next couple of years, and you can mark that up, and that's your cash flow increase, and then all of a sudden you don't get that improvement, these deals will, they won't work anymore. And so I think that's where some of the issues come in.
When you say you work with a lot of investors, when you say won't work, what doesn't work?
You won't hit returns. You won't hit the thresholds that you need in order to.
So then what will you have to do? No. Hold on. What will you have to do? If you can't hit the thresholds or returns, what do you have to do?
Sell the property or find a way to finagle it around.
No, as an investor, you can't pay the price.
Right.
You either go buy something else or you can't pay the price. You have to pay a lower price.
If you own it now and you restrict my ability to make the return I need to, I have to sell it to get out and move my money somewhere else. Or you pay a lower price because you underwrite it to a certain number, to your point. You take your money elsewhere or you offer something lower. But what the government considers a fair return is not what we consider a fair return. I mean, you have a treasury that's 10-year at, a half a point. That's not a fair return for most investors, at least, that are looking, or even property owners. They want something better than that. So
go back to the 15%, because I think that's a big one, and maybe walk somebody through an example. You talked about the 87-year-old. You just talked about a 30-year-old, 30-year tenant. But in LA right now, based on rent control or West Hollywood or some of these places, that could mean that somebody's paying $900 on a 3-bedroom in a good neighborhood.
So we had a situation like this a couple of years ago, and this is a perfect example. I had a client that actually ended up buying a person out of the unit, and they bought them an entire condo in Long Beach because they were in a 3-bedroom in Santa Monica, 2 blocks from the beach, paying $700. The unit at market was worth over $7,000 a month. And they ended up determining, and they'll tell you it's the best money that they ever spent. But in theory, if that lady had moved out, what vacancy decontrol would allow is that for the first 3 years following, you could only raise the rent by a total of 15%. So let's just say and I don't think it's not as fully defined yet if it's going to be 15% in one shot or 15% broken out. But in theory, you're really only raising your rent at that point to $805 or $850 from $700 when it's a $7,000 unit. That doesn't do you any good. That's what's going to encourage people to buy it. Essentially. To take
what about in year 4? What do you get to do?
You're probably stuck with the regular rent increase, which is going to be 3%. So you're screwed. Your unit will be stuck at so far under market. What I would tell anybody is if this is about to get passed and put in place and you have someone so far under market, if you can afford it, buy them out of the unit and put it up to market before this happens, if you plan to keep your money in the state.
That was fantastic advice. We got a couple questions here. One, I'm going to talk about, Mohammed has a question here. How can I get a government-backed loan? Mohammed, I'm going to assume you've got a multifamily property of reasonable size. And if that's the case, I'll reach out to you, or there are local specialists. We'll get on a call with you. We'll introduce you to a couple, learn a little bit more about what you're looking to do in your situation, and then help you figure out if that is the right choice for you, or if, other sort of debt that is available today might be the right option for you with where you want to go. Couple other questions we'll hit, kind of good part. After the 3-year cap expires, can local authorities set rent or guidelines? I think we just kind of answered it. AB 1482 would apply on a state level, but also you want to talk about local municipalities could do what?
Local municipalities could force their rent control back on top of it after that. So normal local rent increases, I mean, some places, I think City of LA might have even frozen it for a year. But it's 3% usually is the max you can increase. So what the government is kindly telling you here is you get 2% above the regular increase if someone moves out, because they're being generous for 3 years, and then you go back to the regular increase. And if you don't think, I saw a question on here earlier about West Hollywood versus Huntington Beach, and we're going through some issues with clients in like West Hollywood and Santa Monica, places that have rent control right now. If you don't think that they're not going to take their pound of flesh and say, no, it's back to whatever our rent control says, then you're wrong. Like, they will absolutely force that down upon you. So it's just going to go back to 3%.
On the Yes on 21 website, the city of West Hollywood endorses Prop 21. It's one of the only cities that endorses it.
Santa Monica?
I don't think so. I couldn't remember, but I know West Hollywood did because I saw the West Hollywood graphic.
Yeah. It's absolutely those cities though. And if any of you have ever built any property at all, you'll see, like, if you do in Santa Monica, West Hollywood, they're just so restrictive and have so much control that they have plenty of their own money to enforce it. So they're going to do things like that. Now, you've gotten great appreciation in West Hollywood and Santa Monica over the last 30 years, but they're making it difficult now.
A couple others that we'll ask, we're at a good midpoint. Will Prop 21 have a bigger, this is opinion, will Prop 21 have a bigger effect on owners who bought recently or have held a long time?
That's a good question. Probably people that have held a long time, but it depends on, it's more about based on what your tenants are.
It's ownership. I think it's ownership style.
It's your management ownership style. What do your leases look like? How have you been managing and running the building? What are your tenants like? I don't think it matters when you bought it. I'm just thinking, if people that have bought properties a long time ago often get comfortable and happy with tenants that pay their rent every month, this and that. They don't necessarily push their rent increases to the max. I can't tell you how many people I've talked to where I've owned the building for 20 years. I've had the same tenant. I didn't push my rent because they paid every month. They were nice. They were kind. And now they're stuck because if they didn't push it every month on an affordable, let's say a rent controlled unit, they're stuck in a not a great situation because they're well below market. And then if this happens, then they would be stuck where they could have at least been pushing it over time. So.
Which, Cyrus, I'm going to come back to your question in a second because Jason kind of leads me to a couple points that I want to make about Prop 21. And Chris's question about who's going to have a bigger impact. And I kind of said it. How it will impact individual owners is that passive, and I mean anyone who does not do any of the following: actively manage their rent roll, audit their lease agreements, and simply operate their buildings like it's a full-time job, are going to be significantly impacted by Prop 21. And even 3088, the changes in documentation alone, just with that, is going to require guys like Jason to update and audit the agreement packages he's been putting together to keep somebody protected. So
at that point, we're changing our document packages, it seems like, once a month now, because there's all these changes in the laws that we have to comply with. And it doesn't do you any good if I give you this really fancy lease. It's all of a sudden going to get you a $2,500 fine because my lease is off. So we're constantly paying attention to keeping this right. And that's the active management's the key.
So Prop 21, people say it doesn't hurt mom and pops. It's our opinion. And we had a graphic when we were able to all get together at our events a year ago, that the Prop 21 people says it hurts corporate landlords. In fact, the legislation only affects mom and pops. And the reason why is that the corporations, the big, large 1,000, 10,000 unit operators, purely operated as a business. They don't have tenants that have been there for 20 years that because they're nice pay 60% of market rent. If that tenant's nice, they've had the privilege of being able to stay in that building at market rent the entire time. So mom and pops like certain tenants and give breaks. Mom and pops don't always know who's living in the unit or breaking the house rules. Mom and pops hire mom and pop management companies that make money by having as little problem at the property as, or little to do at the property as possible. And mom and pops think the tenants that don't mention anything means they've got no problems. Those are the owners that are going to be affected the most. Proper or professional owners, and mom and pops can operate professionally, but for the most part, our owners are passive. They don't want the problem. They want the person to stay in there where they don't have to put in new flooring and make the unit look good. And so they'll let somebody be in there at 60% off of market rent. But professional owners manage the cash flow, not the tenants. They enforce rules and get people out for violating leases. And they proactively manage the property, seeking out problems that they can actively fix. And that's the difference. That's who's going to be impacted the most. That's why when we talk about some of these options for people, there's options for people to stay in California that are going to do really well. But they have to, in our opinion, you got to align with the rules of the game. How does it impact the market? More restrictive rental policies will do one thing. It's going to change investors' ability to get returns. And when you change the ability to get returns, you change price, either positively or negatively. And this looks more negatively than positive. Prop 21, for example, is going to reduce the number of flippers by a significant margin. Flippers, being the people that take old buildings and make them look nice and cool. The people that attract tenants to pay top dollar. That as investors, we love when that group comes in because all they're going to do is make the tenants that we subsequently get like the area and pay a little bit more. But because they're not going to be able to get their returns, get people out as easily, move rents up as quickly, there's not going to be a market for that. Investors require returns, and Prop 21 does two problematic things. It caps rent increases and increases the time in which investors can achieve their desired outcome. Those two things only have one impact on valuation, and it's that it doesn't help. Jason said earlier, it takes longer to hit a return target. Those buyers are going to do one of two things: either invest in other opportunities or offer lower prices that are going to meet their desired objectives. So when we look at 21 and what its impact is, again, like we looked at 3088, and the impact on cash flow was one thing, but the impact on value was more significant. The same thing with 21. Yeah, for somebody, are you going to make less on your building this year or next year because of 21? No, your rent is probably going to be slightly higher, but that equity that you have in the building, is it making you as much money as you possibly can with the asset you have right now? And that's where I think that we're going to talk about in the last 15 minutes, the options and how people can use their equity to do way better. You got any additional comments on you think the investment impact of 21?
So when they say it doesn't affect mom and pops, and I think you're dead on, is it only affects them because three things. One, bigger institutions borrow money at a lower rate. Their cost of capital, both from investors on the equity side and on the debt side, is less than what the average buyer of real estate can get. So they can absorb moves in cash flows and still buy deals and make it work. Also, Justin, to your point, they have their own management companies or they're actively managing their properties. So rolling in another 2 units to 200 units doesn't affect them. It actually lowers their management costs across their portfolio. And they've already got a system in place that allows them to execute effectively and fix things that if you're not actively managing. Like I have a client right now that owns 4,000 units and he's buying a few 7-unit buildings. And the broker's like, well, why is he buying the 7-unit buildings? And the answer was because they're good opportunities and he can do more with them than someone else that owns 20 units buying the 7-unit buildings. And so that's because the cost of capital is cheaper on both equity and debt. Their management costs are lower and they're better at managing because that's what they do. That's their business, to your point.
We're going to get into options in the last 15 minutes, but Cyrus, for your question, can you raise rents in Orange County right this minute? You can, but should 21 pass, I can guarantee you, bet you a lift ticket at Vail, that Santa Ana will be the first place that has significant rent restrictions and ability to raise rent. We know they've been trying. We know they'll continue to try. Cyrus, it's also nice to have you back. It's been a few too many weeks for you and I not to have talked on the webinar. So what I want to get into is options. And again, preface it. I've always been a big believer in the opportunity in California, and I'm a big believer in the opportunity in investment real estate. And I think that there's lots of things that we can do. Our conversation today isn't doom and gloom that your cash flow is going to be wiped away tomorrow. Our real conversation and what we want to stress at Centennial is, can you use that equity to do better? And that's where, at least my opinion for most people on California, has started to change. We're going to talk about 5 options today. 4 of them, really good. They're proactive and they put owners in positions to do better. So 80%, pretty good score when you look at 3088 and the possibility of 21 passing and owners staring at that reality. I'm going to start with option number 5. Not number 1. This is option number 5. Yesterday, Gus, who specializes in Paramount and Bellflower and Compton, was at a meeting yesterday with a really big owner, and he said there were 3 options, but his option 3 is my option 5, and that's do nothing and get run over. That is what some people will do, but you look like you're going to bear the brunt of the problems created by others. Do nothing is going to endure avoidable losses and unnecessary headaches that result just from complacency and the desire to avoid change. So that's option number 5. The 4 ones that we think are good is number 1, refi ASAP. If you've got a very strong equity position in your building, before lenders get a handle on 3088 and 21, go stockpile a bunch of cash to buy assets. Because as we talked about the impact of 3088, we talk about the impact on lenders with 21, you're going to be able to buy some of these properties because there will be sales. If I would have answered poll question number 1, in the next 12 months or 6 months, our value is going to be lower. I think in spite of the fact that we have amazing rates and that inflation should help investment real estate, the laws in California are going to make it challenging and cap rates are going to adjust and push up. So what we will naturally see is that death, divorce, partnership breakup, all things that happen, but all 3 of those things happen more during pandemics and economic downturns, is good properties are going to become available. And if you have the right management procedures, it'll make them new California profitable. So option number 1, go use these incredible interest rates to get some cash to acquire good assets as they become available when cap rates push out a little bit. So that's option number 1. Option number 2, we've been talking about it for 6 months. Since we all got locked down, exchanging out of California has been one of the things that we've been talking about. I said it, interest rates are awesome, inflation is good for real estate, and there are states that love business and make real estate investing attractive. I was sitting today at lunch having a salad and nice tea, and I was listening to 2 conversations in a patio that had only 4 tables talking about leaving California. For work, for opportunity, for it's just, you've had enough. This isn't 40 or 30 or 20 years ago. It's easy to get there. Your equity is increased where you can afford great buildings and true professional property managers. That might be one of the things that I'll have Jason comment on in the last 10 minutes is the difference in property management, the quality of his clients who have 5 and 10 and 12 unit buildings, and his clients who have 100 unit buildings. The quality of property management that the professional investor employs. But going back to it, it's not 20 or 30 or 40 years ago. We say on the exchange, this isn't like when we were faxing documents and your phone took up your entire glove compartment in your car. We've learned a thing or two. Things have changed. Technology is so advanced that you can see everything happening in your property from thousands of miles away. You want to know who gets the most Amazon packages at the property? You can know it. You want to know who parks in front of somebody else's garage? You can find that out too. And you can also tell within days that your water usage is higher in a certain month. Technology can tell us all of it. We're not that far away. And there are no hurdles, alligator pits, or sand in some of these other places. There are also places growing like LA in the 70s or Orange County in the 80s and 90s that you can tap into and take advantage of. So option number 2, Exchange California. You've heard us say it. Would it have been easier to start 6 months ago? Yes. Do we have clients right now that are in that process that are super excited with each passing thing that they see? Absolutely. But it doesn't mean it's too late. Option number 3, change how you operate buildings. We know the best practices, and we've aligned ourselves with the best of the best in property efficiencies to help effectively operate in today's and tomorrow's rules. So whether it's proactively encouraging turnover, investing in a complete set of operating documents that protects you as the owner, but also protects your good tenants, frequently visiting the property to make sure that your house rules are enforced, or more extensively screening applicants because all tenants aren't equal, is it option number 3. And we can help people go from passive to that active level of management, or at least understand whether that active level of management is what they want to do. Option number 4, for those of you that just can't leave California, not all of California is the same. For example, I already said that the city of West Hollywood is endorsing 21. West Hollywood is also a top 10 crime city in California. You can have that, or you can go out to Riverside County that has 2 of the 5 fastest growing cities in California. Or you can go to Huntington Beach, where I guarantee you there is not an owner in that town that is worried about vacancy control. And the city of Huntington Beach enacting vacancy control. So for those that can't leave, they just want to stay, there are options just within California where you can redeploy equity to do better. So Jason, you got any comments on our 4 fantastic options and our 5th, maybe not so great option?
I definitely wouldn't do number 5. One of the interesting things too, Justin, to your point about option 1, is option 1 allows you to stay in California and take capital to begin to diversify outside of California. So you can keep your assets here if you feel like you really need to have it, and then start seeing what life is like in other states. And that eventually might lead you to moving all your assets out of state. And so that's just like one big thing to keep in mind, is if you can cash out refi a good amount of money and you start buying, something in another state, and you start seeing your return, and you're like, wow, I'm ready to sell every building I have in California and move them to wherever, I think is a good idea. I think the one thing to keep in mind is, and I've always noticed this about your brokerage, but it's you guys are advisors, not just like agents or brokers. If you sit down with your advisor, they're going to put together a plan that actually works for you, meets your needs, and help you move money around. It's not just about going about and doing it on your own, whether it's property management, cash out refi, moving money out of state. All those options are something that someone can actually help you with, so then you don't feel like you're going in blind competing against locals or professionals that's their market. You'll have an advisor that helps you through the process. So that's just something else to keep in mind, is you're not jumping into something on your own. And look at switching asset classes too, by the way. If you don't want to be management, but you want to be in California, maybe you go into like a single tenant, triple net fast food restaurant that's a Chick-fil-A or a, Carl's Jr. or Burger King or something like that, where you have a really great tenant that's credit tenant that's going to be there forever, that has been probably increased revenue during the pandemic, and you don't have to worry about management.
That's a great suggestion. And for those of you that have some additional questions, feel free to get them in the chat right now. And to Jason's point, today we tried to not just this is your only option or this is all terrible. We wanted to give you what it means and how it impacts you, but lay out multiple options because not everybody's situation is the same. Whether it's what your objective is purely from a financial standpoint or how your level of activity or desire to actively operate properties. All those things are factored into it, including what your plan is for your equity and your real estate after you're gone. All those things play into it. And I can assure you that all of our team wants to help you figure out what the best option is. 2 days ago, Sean Bainey, who does industrial down in Orange County, he brought me out on a meeting and we're talking to an owner who's got a little bit of equity that he needs to trade and put into something. And he's in his ID period and wasn't getting help from the realtor that he had employed. But he had a beautiful $4 million industrial building, something that we'd love to sell. And as we're talking to the guy and going through the process and learning a little bit about him and his tenant and how Prop 15 may or may not impact him, I was really impressed because Sean just looked at him and goes, Roger, well, we'd love to help you with that. Honestly, based on everything you're telling me, that's one of those buildings that isn't going to be affected. And if you love it and it works for you, you should be holding on to that thing. So, whatever is the right option, we're happy to give you that advice. And our kind of philosophy and opinion is that when it's right and you have an opportunity that you want to take advantage of, we'll still be here. And we'll be happy to help you. So in all of these, if maybe one of those 5 options isn't exactly perfect, we can design something for you that works. Mohammed's got a question for you, Jason. Does rent control apply to commercial property?
No, it does not. Rent control will not apply to commercial properties. It's just for residential. And Justin, to the point you just made, the best strategy, which your advisor will help you with, is probably a combination of options 1 through 4 or multiple put together, right? Like you're probably going to take 2 or 3 and do an all-inclusive strategy versus be like, I have to just do option 1 or I have to do option 3. So.
Exactly. And Mohammed, to your question about rent control, yeah, on your commercial property, no. Where you're probably going to be impacted, at least on your commercial stuff, is Prop 15 and property tax change. It's my assumption based on your question about commercial and your government-backed loan question that the value of all of your investment property will be used to determine if you're eligible for the increased property tax. Jason, that the way you...
There's different things affecting commercial and residential right now, both. So yes, 21-3088, that all affects residential. But 2 weeks ago, we talked about how bad the change in Prop 15 will affect you as a commercial owner. I mean, we're looking at it right now where we have I have a client that owns a building and there's someone signing a long-term lease and they're trying to get a cap on property taxes on the triple net side. And my client's like, no, because they don't know my basis in the building, but I've owned it. It's in Beverly Hills and he's owned it for 25 years. And just imagine his property taxes are going to go up 10, 12, 14 fold potentially, maybe 20 fold max. He's like, I can't put a cap on it because then he goes, their rent, the property taxes are going to increase more than what they're paying in rent. So that's just something to keep in mind if you've owned your commercial for a long time. So
that's a great comment and great way to finish up. Want to thank everybody who participated in the polls. Recap, will prices be higher in 12 months? It was tied with a couple maybes. But on the rent side, 50% weighed in, said no on that one. In 2022, would you rather own in Huntington Beach or West Hollywood? Huntington Beach, 91% to 9 for West Hollywood. That being said, there's still people that'll buy in West Hollywood, and it'll make sense for them to do it. But all things being equal for passive owners, I would agree. 5 years from now, what will be your best investment? Refi and buy more California real estate got 0 votes. I don't think it's that high. I think there's people that are going to do really well in California. I'm just not sure it's everybody. Exchange California came in with 54% of the votes. One thing about Exchange California that I want to talk about is for those of you that are interested in it and you're thinking, Centennial, you guys are a local, Southern California based firm. We are, and we have national relationships with top investment brokers in every city. One of the good parts about spending 20 years in this business and being with a big national firm that where a lot of people move on is that you got a lot of relationships in just about every city. And I can assure you that we're going to tap into those for your benefit as we put together an Exchange California strategy. 9% got, go ahead.
You can exchange. There's a lot of confusion regarding exchange. It's just fee title for fee title. So you can exchange an apartment building in California to an industrial building in Texas. You can exchange across state lines, and you can exchange from one property type to another, as long as it's an investment property. You can even exchange a rental home into, I don't know, a single tenant triple net in Nashville. So
absolutely. And we've done all of those. Otherwise, 5 years from now, I know we're over a minute, but since we had the technical difficulty, I'll let it run. Keeping what you have today got 9%. Blue cities to red cities got 36%. Honestly, we're not seeing enough of that. We got way too many people that are passive owners in LA or West Hollywood or Santa Ana, Cyrus, although you're an active owner, but still. We'd rather see you in a red city. Got 36.4% of the votes. I want to know, help me figure it out, got 0, bummer. In 2022, would you rather own in California or out of California? We got 62% stay in California, 38% said get me out of state. And what will happen first? New legislation that helps landlords got 0%. We're all on the same page there. Something like Prop 21 passes got 82%. I just want to reinforce that if you think this, we should have a plan and be ahead of it because it's going to happen. California gets a business-friendly governor, came in at a whopping 0%. Biden ends the 1031 exchange, got 0. I think we all hope that, although we've heard that might not be the case. And the economy totally reopens at 20%. Jason, I want to thank you for joining us. It's great to hear your insight and commentary, both for everybody on our team and our clients. I want to thank you all for joining us. And next week, we will be back at it again, talking about the issues that affect investment real estate ownership in Southern California. Thank you, everyone. Bye.